Hi friends, the name of the channel is Accounts and Taxation Ka Gyan. The link of the channel is @accounts and taxation ka gyan. Today we'll discuss two topics, which is security deposit, which is given by the lessee to the lessor, interest free, and employee loan given at reduced rate of interest to the employees. So this would involve interplay between Ind AS 32109 and Ind AS 116. This is what we have for this video. Please do subscribe to the channel and like and share the comment on the video. Thank you so much. Today we'll discuss interest-free deposit by lessee to the lessor, Ind AS 116, interplay between Ind AS 32 and 109. We'll start this discussion with an example. Lessee pays 10 lakh rupees as interest-free deposit to the lessor, which is refundable after 5 years. The market rate of interest is 10%. How would you account for the same in the books of the lessee? So we'll discuss this example in detail today. How the interest-free deposit to lessor would be accounted for as per Ind AS 116 and interplay between Ind AS 32 and 109. So first step is we would have to compute the present value of the interest-free security deposit. How to compute the present value? 10 lakh into 1 divided by 1.10 raised to the power of 5. This is the present value factor. 1 divided by 1.10 raised to the power of 5 is the present value factor. This multiplied by 10 lakhs would give the present value. So the present value comes to 620921. Now we've given a deposit of 10 lakhs and the present value of security deposit is 620921. Where the difference would go? The difference would go to prepaid rent, which would be capitalized as ROU asset. So this prepaid rent would be capitalized as ROU asset. So the entry would be security deposit account debit 620921, ROU asset account debit, which is prepaid rent 379078, to bank 10 lakhs. Now the ROU asset would have to be depreciated over the 5-year period. The entry for the same would be depreciation account debit 379078 divided by 5, 75815 is the figure, to ROU asset 75815. This would be passed for each of the financial years for a 5-year period. Now this is the second entry which has been passed. Now the SD amount is 620921, and once we'll receive back the SD amount, it will be 10 lakhs. So how this difference between 620921 and 10 lakhs would be accounted for? This would be interest income, and how this interest income would be accounted for would be shown as below. So opening balance 620921, 10% of that is 62092. If we add 62092 to 62091, the closing balance would be 683013. Now 683013 would be the opening balance. If we compute 10% on that, 68301 would be the interest amount, and 751,314 would be the closing balance. 751,314 would be the opening balance for the next year, that is third year, and 10% of that would be 75131, and the closing balance would be 826446. 826446 would be the opening balance for fourth year. 82645 would be the interest amount. 909090 would be the closing balance. 909090 would be the opening balance for fifth year. 90909 would be the interest amount, and 10 lakhs would be the closing balance. So this journey from 620921 to 10 lakhs would be through interest income. So how this interest income would be accounted for? The year 1 would be SD account debit 62092 to interest income 62092. Year 2 would be SD account debit 68301 to interest income 68301. Year 3 would be SD account debit 75131 to interest income 75131. And year 4 would be SD account debit 82645 to interest income 82645. Year 5 would be SD account debit 90909 to interest income 90909. Now this is the complete accounting for the security deposit which has been received, which has been paid to the lessor, and is refundable after 5 years. So, how the charge in P&L would take place as a result of these accounting entries? Now we see that the interest is 62092 and depreciation is 75815 in the year one. So there will be an additional charge of 13723 in the year one. Now, in the year two, 68301 is the interest income, and depreciation charge is 7518815, and hence there will be an additional charge of 7514 to the P&L. The in year three, 75131 is the interest income, and 75815 is the depreciation. So 684 would be the additional charge on the P&L. In year 4, 82645 would be the interest income, and 75815 would be the depreciation amount. So there would be an income of 6830 in the year 4, and in year 5, 90909 would be the interest income, and depreciation charge would be 75815. So there will be an additional income of 15094. If we take into account the P&L charge for all the 5 years, the amount would be zero. So this is the effect of accounting of Ind AS 116 along with Ind AS 32 and along with Ind AS 109. So as security deposit is a financial asset, this way the accounting for the security deposit would take place. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much. Hi, good evening. Today we'll discuss employee loan at below market rate of interest, that is Ind AS 109. So to start with, we'll first discuss the concept. So financial assets can be measured at amortized cost, FET OCI or FET PNL. Now the initial measurement in all the three cases would be at fair value. That is, for amortized cost, the initial measurement would be at fair value. For FET OCI, that is fair value through OCI would be fair value, and for FET PNL would be fair value. The subsequent measurement for all the three categories would be for amortized cost, it will be at amortized cost, and for fair value through OCI and fair value through PNL, it will be at fair value. Now the transaction costs have to be added to amortized cost and FET OCI and charged to PNL in case of FET PNL. This is the concept of financial assets for computing the accounting for the same. Now we'll discuss an elaborate example to discuss how this fair value would be taken into consideration. A company gives a loan to employee at 5% of an amount for an amount of rupees 20 lakhs. The market rate of interest is 10%, and 1/5 of the loan is repayable at the end of the year. So first we'll do the computation as to what will be the inflows, what will be the outflows, and how the interest computation would take place. So to start with, the loan is for 20 lakhs. 20 lakhs is the loan amount. Repayment is 1/5 at the end of each year. That is 1/5 of 20 lakhs is 4 lakhs. So 4 lakhs would be the repayment amount at the end of each year. Now interest at the rate of 5%. Since the repayment is happening at the end of the year, so interest would be computed on the initial loan value of 20 lakhs. That will be 5% of that will be 1 lakh. So the total inflow from the employee to the company would be 4 lakh repayment plus 1 lakh interest. That will be 5 lakhs. In the second year, 20 lakhs minus 4 lakhs, 16 lakhs would be the closing balance, which will be the opening balance for the second year. 16 lakhs, 5% of that would be 80,000, and 4 lakhs would be the repayment amount. So the total outflow would be 4 lakh plus 80,000, that will be 4 lakh 80,000. In the third year, 16 lakhs minus 4 lakhs, 12 lakhs would be the opening balance. 12 lakhs, 5% would be 60,000. So 4 lakh would be the repayment amount. 4 lakh plus 60,000 would be the total inflow. 4 lakh 60,000 would be the total inflow. And the opening balance for fourth year would be 8 lakhs. 8 lakhs, 5% of that would be 40,000. 4 lakh plus 40,000 would be the 4 lakh 40,000 would be the total inflow, and closing balance would be 4 lakhs, which will be the opening balance for the fifth year. 4 lakhs, 5% of that would be 20,000. 4 lakh 20,000 would be the total inflow, and the closing balance would be 0. So the total of interest at 5% would be amounting to rupees 3 lakhs, and total of interest inflow would be 23 lakhs. Now we'll compute the inflow, which is 5 lakh, 4 lakh 80,000, 4 lakh 60,000, 4 lakh 40,000 and 4 lakh 20,000. Now we'll compute the present value of these inflows. So the present value of this inflow, 5 lakh into present value factor. The market rate of interest is 10%. So 1 divided by 1.10 raised to the power of 1 would be 0.909. So 5 lakh into 0.909, 454545 would be the present value for the first year. For the second year, 4 lakh 80,000 into 1 divided by 1.10 raised to the power of 2, that will be 0.826. 396694 would be the present value for the second year. 4 lakh 60,000 into 1 divided by 1.10 raised to the power of 3 would be the present value factor for third year, that will be 0.751. 4 lakh 60,000 into 0.751 would be 345604 would be the present value for the year 3. For the year 4, 4 lakh 40,000 into 1 divided by 1.10 raised to the power of 4, that will be 0.683. 4 lakh 40,000 into 0.683, 300525 would be the present value for the year 4. And for the year 5, 4 lakh 20,000 into 1 divided by 1.10 raised to the power of 5, 260786 would be the present value, and the total of these present values would be 1758157. Now present value of the loan is 1758157. 10% at market rate of interest would be 175,815. Inflow would be 5 lakh. So 175,857 plus 175,815 minus 5 lakhs would be 1433973. This will be the opening balance for the year 2. 1433973 minus 4 lakh 80,000 and 1 into 1433973 into 10% would be 1433997. 1433973 plus 1433997 minus 4 lakh 80,000 would be 1097370. For the year 3, 1097370 into 10%, 1097337 less inflow 4 lakh 60,000, 747107 would be the opening balance for the year 4. Now 747107 into 10% would be 74710. 74707 plus 74710 minus 4 lakh 40,000 would be 381818, which will be the opening balance for the year 5. 381818, 10% of that would be 38181. So we'll add 38118 to 38181 less 4 lakh 20,000 would be 0. So the total interest at 10% would be 541,842. In the P&L, the credit of the interest at 10% would be 541,842 and debit of the interest would be 3 lakhs. So in the P&L 241,843 would be charged. So this 241,843 plus present value of the loan 175,8157, the total amount of loan 20 lakhs would be there. Now we'll discuss the scheme of entries. So 175,8157 is the present value of the loan. So employee loan account debit would be 175,8157. To bank would be 20 lakh, and the differential of the two would go to prepaid employee expense account. That will be 241,843, which is the amount in the credit of the P&L. So 241,843 would be the prepaid employee expense account. Now prepaid employee expense account would be amortized over 5-year period at the same value. So this P&L, the accounting entry for the same would be P&L account debit to prepaid employee expense for each of the 5 years with 48368 in each of the 5 years. Now the credit of the credit to the P&L would be debit would be to employee loan account, and credit would be to interest income with 10% of the interest income. So these figures 175,815 would be the amount to be credited at the end of first year. So employee loan account debit 175,815 to interest income 175,815. In the year 2, the 10% interest amount is 143397. So in the year 2, the employee loan account would be debited 143397 to interest income account 143397. In the year 3, 109737 is the interest income. So employee loan account would be debited with employee 109737 and to interest income 109737. In the year 4, 74710 would be the interest income. So employee loan account debit 74710 to interest income 74710. In the year 5, 38181 would be the interest income. So employee loan account debit 38181 to interest income 38181. Now there would be repayment by the employee at the end of each year. So the repayment amount which we discussed was 5 lakhs, 480, 460, 440, 420. So the repayment would be as follows: bank account debit to employee loan account 5 lakhs, bank account debit 4,80,000 to employee loan account 4,80,000, bank account debit 4,60,000 to employee loan account 4,60,000, bank account debit 4,40,000 to employee loan account 4,40,000, bank account debit 4,20,000 to employee loan account 4,20,000. Now we'll see the balance in the employee loan account. Opening balance was 175,8157. The total of 5-year interest at 10% was 541,842, and the payment to the employee loan account was 23 lakhs, which is these payments. So the total of employee loan is balanced: 23 lakhs in the debit, 23 lakhs in the credit. This gives a closing balance of 0. Now we'll see the charge to the P&L. Prepaid employee cost is 48368, which is same over the period of 5 years. Prepaid employee cost debit to the P&L would be 48368, 48368, 48368, 48368, 48368 for each of the 5 years, and the credit of interest income at 10% would be 175,815, 143397, 109737, 74710, 38181. This would be the interest income for each of the 5 years. The total of these, the difference between the two would be 3 lakhs, which is the difference 3 lakhs, which is the difference between 20 lakhs and 23 lakhs with loan amount. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much. हाय फ्रेंड्स, आपको कैसा लगा आज का वीडियो ये बताइएगा एंड शेयर दिस वीडियो टू द मैक्सिमम पॉसिबल एक्सटेंट. प्लीज़ सब्सक्राइब टू द चैनल अकाउंट्स एंड टैक्सेशन का ज्ञान. द लिंक ऑफ द चैनल इज़ @अकाउंट्स एंड टैक्सेशन का ज्ञान. Please share the video and like and share, put your comments. Thank you so much.